Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at RCAT.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And yeah, let's just jump right into today's mission.
Right, exactly. So for your portfolio today, we are unpacking a really rapidly developing situation in the defense technology space.
Yeah, we are tracking RCAT.
Which has, it's already surged over 60% so far in 2026.
60%, yeah.
And look, whenever you see a staggering number like that in just a few short months,
Right.
the immediate question for your wealth building strategy is always the same.
Is this just a fleeting momentum trade?
Exactly. Did you already miss the boat? Or, are we actually looking at the foundation of a long-term wealth building opportunity here?
Because separating that hype cycle from a true structural shift, that is how you actually build smart wealth.
Totally. So today we're going to figure out exactly what is driving this breakout.
Why their specific tech is winning over the government.
Right. And critically, whether their underlying financials can actually support these wild moves.
Because that 60% year-to-date figure, it's definitely turning heads.
Oh, absolutely.
But to really understand what it means for your investments, we need to look under the hood at the immediate price action first.
Let's do it.
So just this past week, the market saw some really substantial intraday surges.
Massive.
Yeah, the stock jumped over 17% on Monday alone.
17% in one day.
Right. And then it followed that up with nearly an 8% gain on Tuesday.
So we're talking about back-to-back explosive days.
Exactly. And look, these are not just random retail spikes. These are structural, fundamental moves. What the market is reacting to is a combination of escalating defense budgets globally,
Which is a huge macro driver.
heavily intertwined with specific, very highly publicized geopolitical tensions. We're talking about the U.S., Israel, and Iran.
And I want to jump in here because it's so crucial for you as an investor to look at those geopolitical events purely through the lens of objective market catalysts.
Right. Keep the emotion out of it.
Exactly. We aren't here to take any kind of political stance on the conflicts in the Middle East or, the recent headlines regarding the Trump and Iran situation.
That's not what this is about.
No. What you have to do to build wealth is analyze how those events act as macroeconomic drivers for defense spending.
Capital flow.
Capital flow, exactly. Those specific tensions and the associated public comments, they lifted RCAT aggressively.
Very aggressively.
And interestingly, we saw it move in tandem with other major industrial peers.
Like Marvell Technology.
Right, Marvell. When you see a specialized defense stock moving alongside a massive giant like Marvell, that usually tells us something much broader about market sentiment, doesn't it?
It signals a sector-wide rotation.
Okay, unpack that a bit for us.
So, the broader market is aggressively repricing defense and industrial technology based on the objective reality of sustained, elevated global conflict risks.
So they're pricing in the long-term risk.
Yes. Investors are moving capital to exactly where the government spending is flowing.
Right.
And this brings us to a really crucial concept for anyone trying to build wealth in these volatile markets.
Which is institutional accumulation.
Exactly. Institutional accumulation. When we look at the trading data from those Monday and Tuesday surges.
Those 17 and 8% days.
Right. The volume profiles show elevated volatility flow and significant options activity.
Oh, wait, let me stop you there. When you see that kind of massive options activity and volume, are we just looking at, retail traders chasing headlines on message boards?
No.
Or is this the whale money, the institutions actually laying down a foundation?
It is entirely the latter. It's the whales. When institutions, the real whales, start moving heavy amounts of capital into options and equity for industrials and defense tech, they are taking positions that suggest they expect sustained momentum.
They aren't day trading a headline.
No, they're betting that the escalating defense focus is a long-term structural shift.
Wow.
And for you, the everyday investor, tracking that institutional flow is incredibly valuable.
Because it shows you where the smart money is going.
It shows you where they're placing their bets for the coming years, not days. Years.
That makes total sense. It's like following the footprints of giants in the snow.
That's a great way to put it.
But look, macro tailwinds and institutional footprints, they only matter if the underlying company actually has a product people want to buy.
A viable business model.
Right. So I want to shift gears to their actual business model. Because Red Cat wasn't always a pure-play defense contractor, were they?
No, they weren't at all. And their strategic pivot is really the central pillar of the bull thesis here.
Okay, let's dig into that.
So for a long time, the drone market was heavily focused on consumer applications.
You mean like photography, real estate, recreational flying?
Exactly, the stuff you buy at an electronics store.
Right.
But Red Cat made a very deliberate, highly aggressive pivot away from the consumer space.
Straight into the defense and military sector.
Directly into it. And to execute this, they acquired some really key assets.
Right.
They acquired Teal drones and FlightWave Aerospace.
And FlightWave Aerospace is the company that makes the Black Widow system, right?
Exactly. The Black Widow system.
So by acquiring Teal drones and FlightWave Aerospace, they completely abandoned the consumer market.
Which is smart, right?
Oh, absolutely.
Yeah.
I mean, the consumer market is just a race to the bottom on price anyway.
Exactly. You're competing with massive overseas volume.
Right. So they leave that behind and start building specialized, Department of Defense approved tactical reconnaissance systems.
Which completely changes their margin profile, or at least the potential for it.
Exactly. But here's the thing for your wealth building strategy. Building a good drone isn't enough to guarantee wealth for shareholders.
No, it's not.
There has to be a competitive advantage. And I understand there is a very specific piece of legislation acting as a shield for them right now.
Oh, yes.
Can you break down exactly what that legislative mode is?
Yeah, this is perhaps the most critical insight for anyone evaluating the stock's long-term potential in their portfolio.
Okay, let's hear it.
We are talking about the fiscal year 2025 National Defense Authorization Act,
The NDAA.
commonly referred to as the NDAA, yes. But more specifically, we have to look at the Federal Communications Commission's implementation of Section 1709.
Okay, hold on. Section 1709 of the FY25 NDAA. That sounds like a lot of government alphabet soup.
It does.
For the listener who is just trying to figure out if this belongs in their portfolio, what does that regulation actually do?
Okay, in plain English,
Please.
it severely restricts the use of foreign drone components in U.S. defense applications. Essentially, the U.S. government has stepped in and explicitly mandated that sensitive military hardware cannot rely on parts manufactured by foreign adversaries.
So you can't just buy a cheap off-the-shelf motor from overseas and slap it in a military drone anymore.
Exactly. Because of this, non-U.S. competition is effectively wiped out for companies like Red Cat.
So if you are a foreign manufacturer,
You are completely locked out of these lucrative military contracts.
that is incredible.
Yeah.
So the government is basically enforcing a monopoly for domestic producers.
You really are.
They are playing the role of a bouncer at a very exclusive club, and they just kicked out all of Red Cat's cheaper overseas competitors.
That's a perfect analogy. And a government-enforced moat is incredibly valuable.
I mean, it's the ultimate competitive advantage.
Right. It protects the company's profit margins from being eroded by a flood of cheap alternatives.
Because nobody else is allowed to bid on the contract.
Exactly. Red Cat's U.S.-made hardware and software now have a distinct, legally mandated advantage in the entire defense procurement process.
That is massive for their pricing power.
And furthermore, once a military branch adopts the Black Widow system or a Teal drone, the switching costs become phenomenally high.
Oh, I love that you brought up switching costs. Because that is such a key metric for long-term wealth.
It really is.
For anyone listening, just think about how annoying it is to try and get your entire extended family to switch from Apple to Android.
It's impossible.
It's an absolute nightmare of retraining, lost data, confused text threads. Now multiply that headache by 1,000.
And apply it to highly classified, lethal military hardware.
Exactly. You don't just easily swap out a tactical system and retrain thousands of combat personnel.
No, you don't.
Once Red Cat is integrated into a platoon's workflow, they are deeply, deeply entrenched.
And that integration is key. And it actually extends beyond just airborne drones.
What do you mean?
Well, if you are building wealth by investing in defense, you really want companies that dominate multiple domains.
Not just the air.
Right. Red Cat isn't stopping at the sky. Through their subsidiary Blue Ops.
Okay, Blue Ops.
Yeah, they are actively testing unmanned surface vessels. USVs.
So autonomous boats.
Exactly. They are building what the military officially calls an integrated family of systems.
Family of systems. Paint a picture of that for us. What does a family of systems actually look like in a real-world scenario?
So imagine a scenario where a Teal drone in the air spots a target or a threat.
Okay.
And it instantaneously, completely autonomously communicates that data to a Blue Ops vessel on the water.
Without human intervention.
Right. They coordinate a response without needing a human to manually relay the coordinates.
Wow.
That multi-domain dominance, providing a seamless tactical picture across air, land, and sea, that is what makes their technology indispensable to the Department of Defense.
Okay, hold on, because the narrative here is phenomenal.
It's very strong.
The multi-domain tech sounds literally like the future of warfare, and the government-enforced moat is, frankly, an investor's dream.
It is.
But I have to play devil's advocate for a moment.
Please do.
Because for your wealth, we have to look at the hard numbers. A great narrative doesn't pay the bills.
No, it doesn't.
When I look at the fundamental metrics here, I am seeing a very extreme picture of a company in a very high-risk scaling phase.
Yes.
Let's talk about the projections versus the current reality.
Okay, the projections are certainly aggressive.
Very.
Analysts are currently forecasting an astounding 90.3% annual revenue growth for 2026.
Over 90% revenue growth.
Alongside a 50.9% growth in earnings per share.
Okay, so those figures reflect immense expectations for financial outperformance.
Right, as these government contracts begin to scale up and actually translate into delivered products.
But a 90% revenue growth projection is the kind of number that makes growth investors salivate.
It is.
But, and this is, but every single listener must factor into their risk assessment.
Yeah.
We have to look at the growing pains.
The current reality.
Right now, RCAT is dealing with severe financial volatility.
Very severe.
I am looking at a pre-tax profit margin of negative 231.7%.
It's a tough number to look at.
Let me repeat that for everyone listening to make sure you caught it. Negative 231.7%.
Yeah.
If they are burning cash that aggressively, isn't there a very real risk they just go bankrupt before they ever see that 90% revenue growth?
That is the ultimate reality check. And it is a question every smart investor needs to be asking right now.
Because it's your money on the line.
Exactly. Margins that deeply negative indicate a tremendous rate of cash burn. Building hardware, especially military-grade autonomous hardware, requires immense upfront capital.
Right. R&D, manufacturing, testing.
All of it. To survive this burn rate without going insolvent, management's entire financial strategy right now is laser-focused on liquidity.
So how exactly are they keeping the lights on? What's the playbook?
They are executing a survival playbook. First, they are engaging in strategic debt restructuring to manage their liabilities.
Pushing out payment dates, that sort of thing.
Exactly. Keeping cash on hand. Second, they are actively reducing capital expenditures wherever possible.
So meaning they aren't buying new factories or equipment unless it is absolutely necessary for a contract.
Right. And third, they are implementing intense cost rationalization programs.
Which is just corporate speak for aggressively slashing their everyday expenses.
Exactly. Slashing costs just to counter broader economic headwinds while they try to scale.
Which means, for you, the shareholder, the wealth-building approach here has to be perfectly aligned with reality.
It has to be.
If you're looking for a safe, steady dividend stock to generate passive income for your retirement, walk away right now.
Yes. RCAT does not offer dividends.
They're not doing stock buybacks to artificially inflate the share price and reward investors today.
No. Every single drop of free cash flow they can muster is being poured directly back into the furnace.
To fuel those growth areas, like those autonomous naval technologies with Blue Ops.
Exactly. You really have to frame this in your mind as venture capital style risk, but taking place in the public markets.
That's a great way to think about it.
They are entirely sacrificing short-term profitability to capture a massive, heavily regulated market share.
With the thesis being that once they secure the contracts and actually scale up production, the revenue will eventually outpace the fixed costs.
And that negative margin will finally flip.
Right.
The market is inherently forward-looking, and institutional investors are often willing to tolerate severe short-term cash burn if they believe the revenue growth thesis is intact.
And protected by that NDAA regulatory moat.
Exactly. The moat is what gives them the patience.
And looking at the recent market sentiment, it really seems Wall Street's tolerance for that cash burn is holding remarkably strong.
It is. The catalyst calendar and the rumor mill are running incredibly hot right now.
Let's talk about that. Just a few days ago, on March 3rd, 2026, we saw a major upgrade from Wall Street.
Yes, from Ladenburg Thalmann.
Right. Analysts there maintained their buy rating on the stock, but they significantly raised their price target.
They took it from $15 all the way up to $20.
which is a substantial vote of confidence.
Oh, massive. Based on where the stock has been trading, that $20 target implies a roughly 36% upside from current level.
36%,
Yep.
on top of the 60% it already ran.
Exactly. When a recognized firm raises a price target that aggressively, especially right in the middle of a 60% year-to-date run,
It provides a lot of validation for the bulls.
it adds incredible fuel to the fire.
And it creates a really fascinating dynamic between the everyday retail investors and those institutional whales we talked about earlier.
It really does.
I mean, if you log on to platforms like StockTwits right now, the retail sentiment is just extremely bullish.
Very loud.
The volume of conversation is high. Retail traders are seeing the geopolitical headlines. They're watching the cool drone footage.
And they are piling into the stock based on the story.
Right. But beneath that loud, sometimes chaotic retail volume, you still have that quieter, steadier institutional flow.
Right. The whales.
Yes. The whales are accumulating shares and options because they view the company as structurally undervalued relative to its 2026 growth projections.
They aren't buying the hype.
No.
They're buying the math behind the multi-domain defense capabilities.
And then, of course, there is the speculative side of the market.
Always.
In the world of high-growth defense tech, rumors can act as explosive short-term catalysts.
And right now, there is an unconfirmed but highly exciting rumor circulating.
Regarding a potential partnership with a company called Allen Control Systems.
Yes. The whisper in the market is that this partnership would be orchestrated through the RCAT Futures Initiative.
And what would be the goal of that?
The goal would be to rapidly accelerate the deployment of autonomous military technology directly into the field.
Now, we must stress for your portfolio strategy, you have to treat this purely as speculation.
Yes, it remains unconfirmed by the company.
Absolutely, it is just a rumor. But in a high momentum environment, even the possibility of a major autonomous tech partnership can keep the bid incredibly strong.
It feeds the narrative that they are aggressively expanding their capabilities.
But eventually, rumors and narratives have to give way to execution.
They do.
What are the concrete scheduled events that investors actually need to be watching over the next 3 months?
Well, we are definitely entering a phase where the company has to prove its strategy is working.
Right.
They just held their Innovation Day on February 27th, which was great for showcasing the technology.
That's in the past now.
Exactly. Looking ahead, your eyes should be firmly fixed on any upcoming USV demonstrations from Blue Ops.
Why are those specific naval demonstrations so critical right now?
Because proving that their autonomous boats work seamlessly with their aerial drones is critical to cementing that family of systems narrative.
Got it. It proves the multi-domain concept.
Yes. If they can show the Department of Defense a flawless integrated demonstration, it dramatically increases the likelihood of securing the large-scale contracts they need.
To hit that 90% revenue growth target.
Precise.
Right. But the ultimate test, the moment of truth for anyone holding this stock in their portfolio, is going to be their Q2 2026 earnings report.
That is when the rubber meets the road.
All of these analyst projections, the narrative about the regulatory moat, the rumors, the Q2 report, is where we will see if the government interest is actually translating into top-line revenue at the speed the market is pricing in.
It's the classic double-edged sword of momentum trading.
High risk, high reward.
The expectations are currently sky high. Management has effectively bet the company's entire financial health on dominating this specific U.S.-only defense niche.
They have the legislative moat, they have the hardware.
But now they have to demonstrate flawless operational scaling to overcome that massive cash burn we talked about.
And if they miss on that top-line growth metric during Q2 earnings,
the punishment on the stock price could be severe.
right, given how much future success is currently baked into the valuation. So, synthesizing all of this down to the final investment thesis for you listening at home, what is the play here for your wealth-building strategy?
Based on the fundamentals, the macro catalysts, and the technical breakouts.
RCAT currently holds a bullish score of 8 out of 10 in our analysis.
An 8 out of 10.
We are looking at this primarily as a highly potent swing trade heading right into those Q2 2026 earnings.
The momentum is clearly there.
The institutional flow is supporting the price action.
And the global geopolitical landscape is acting as a relentless tailwind.
And if they execute, the timeline shifts.
Yes. If that Q2 report proves that their multi-domain defense dominance is resulting in scalable, sticky revenue.
This transitions from a short-term swing trade into a legitimate multi-year hold for your portfolio.
It is entirely about managing the risk of that immediate cash burn against the immense upside of owning a government-protected monopoly in tactical defense tech.
That is the wealth builder's mindset right there. Weigh the risk of the burn against the protection of the moat.
And as you consider how this fits into your own portfolio, I want to leave you with one deeper question to ponder.
Go for it.
We have established that a huge part of this bullish thesis is heavily protected by government regulation.
Right, the NDAA.
The NDAA is actively blocking foreign competitors, and active geopolitical conflicts are fueling immediate demand.
True.
But what happens to your investment if those winds change?
That's a great question.
What if those strict regulations are eventually relaxed to cut government costs? Or what if the geopolitical landscape suddenly stabilizes?
Right.
You have to ask yourself, can Red Cat's technology, their drones and surface vessels, stand entirely on their own merits in a truly free global market without that regulatory shield protecting them?
That is exactly the kind of critical thinking that separates reactive traders from strategic wealth builders. You always have to know what structural forces are actually protecting your money and what happens if those forces disappear. Keep a close eye on those upcoming naval demonstrations, manage your risk heading into Q2 earnings, and as always, keep building your smart wealth. We will see you next time.